expect that gold will maintain its purchasing power. If the US dollar lost 75% of its purchasing power, that would suggest a threefold to fourfold increase. It's simple math.
Potentially $8,000 to $12,000 gold.
Yeah.
Over a 10-year period.
I would be surprised over a 10-year period if the gold price wasn't measured in 5 as opposed to 4 digits. So gold is not merely at nominal all-time highs, but probably at constant dollar all-time highs. Silver is far from an all-time high. $57 comparing to 50 forgets the fact that 15 years has passed since the last time they were at 50.
The first time silver hit $50 was what, back in the 70s, isn't it? So nominally, based on that,
it's probably 220, 225. Once silver begins to outperform gold, the performance in silver is roughly double the price of gold. Most of the investment community still can't spell gold, despite the fact that it's a 4-letter word. It is very, 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 very underowned. I'm not saying to you that silver is going to go 8 to 1. What I am saying is that a move higher in silver, from my point of view, is statistically extremely probable. My experience has been that precious metals bull markets are established by gold. It's the fear buyer.
yeah,
And when the momentum in the gold price attracts generalist investors to the space,
yeah,
market leadership changes from gold to silver. This will be the 4th time in my life that this occurred. It looks like in the market that transfer is taking place as we speak. Whether or not that's true, of course, time will tell. When leadership transition does take place, silver outperforms gold pretty dramatically. And the high quality silver stocks outperform any other extractive asset class I know. I hope you paid attention to the part where I said high quality, though.
yeah.
There are a lot of purported silver companies that litter the speculative landscape who unfortunately have no silver. Those can uniformly be expected to do well too for a little while, but they're treacherous places to be.
Yeah, and we've always seen this with rallies though, haven't we? Well, I'm sure we're already seeing some more silver names prop up as well. We saw it in lithium, everyone turned into a lithium company when the price rose. So I'm sure that will be happening. But what I've heard in the past as well is that when we do see that silver price start to rally and pick up, and everyone's, your barber's talking about investing in silver stocks, that's probably a time where you should probably be more cautious.
A quiet shift like this, gold handing leadership to silver, often signals a deeper rotation that most investors only notice after it's too late. Silver's historic outperformance during these transitions is real, but Rick Rule's warning about quality can't be ignored, especially when more than half the so-called silver companies barely produce any silver at all. Retail enthusiasm always spikes near turning points, and we've seen this movie in lithium, uranium, even rare earths. When the Barber indicator shows up, volatility isn't far behind, and what comes next reveals why early enthusiasm often turns into late cycle risk.
Oh, are we there yet?
Oh, not close.
No?
No, not close. These are truly dramatic runs. And I'm not saying it has to happen. I'm just saying that 3 times before in my life it has happened. And I'm hoping at age 72 it happens to me one more time. But let me give you a couple of arithmetic stories to warm up your audience.
Okay.
I came into the business in the 1970s, the most dramatic precious metals bull market in recorded history. One little silver company, then Coeur d'Alene Mines, now Coeur, started 1970 at 10 cents and ended 1981 at $65. Now, I was too young, too dumb, too poor to pay attention. But in the little rally that we had in the first part of the decade of the 90s, I helped float 2 silver companies, one Silver Standard, the other Pan American. They went from 72 cents respectively to $45, 72 cents and 50 cents respectively, to $45 or $46 in the space of 6 short years. These are truly breathtaking moves. They are not to be done with money that you had set aside for a child's college education.
Yeah.
But they are the kind of moves that can take mad money and turn it into real money.
Okay, so in terms of where we are in the cycle at the moment, because I can't think of any silver companies that have done that dramatic of a move yet.
This part drops a quiet bomb. The investor psychology today doesn't remotely resemble the conditions that produced those 20x to 600x silver runs. Rick Rule references the 1970-1981 run where Coeur d'Alene didn't just double, it went from $0.10 to $65. A 650x explosion that happened during inflation, rate shocks, and currency fear. Even the 1990s rally delivered 60x moves in 6 years. Those returns require extreme dislocations, not mild optimism. If today's cycle rhymes with those periods, the acceleration phase hasn't even started. Next, he breaks down why the margins still don't justify a late cycle label.
Are we still fairly early on in this cycle, in your view?
I think we are. We haven't had the type of move in the silver market that would allow the senior producers' margins to increase as dramatically as the gold producers have. The strength that we've seen in the gold market for the last 18 months has a lot to do with the fact that they're making so much money. Yeah. The silver guys haven't had that happen to them yet.
They must be getting close though, don't you think?
You bet.
Because let's have a think. So most silver companies, what's their ASIC? Around $15 to $20, would it be?
Well, that's a trick question, because only about 18% of primary silver supply comes from silver mines. Right. 82% comes from copper mines or lead mines or zinc mines. One could say, as an example with Freeport-McMoRan, that their cost to produce silver is zero because their mining costs are paid for by copper. They just have to strip it out of the stream. The real silver producers, the Pan Americans of the world, the Fresnillos of the world, the Buenaventuras of the world, the real ones, are nominally $20 producers. But
so their margin now is almost 200%.
Margin's good.
Yeah.
The margin's good. Okay. Now, it is likely, although not certain, that one of the ways that they got through periods of low silver prices was by producing at mine grades that were higher than the average reserve grade.
Here's the uncomfortable truth. The silver market isn't behaving like a mature bull cycle because the underlying margins haven't detonated yet. Gold producers are printing cash, 18 months of outsized profitability, but silver producers are only now creeping toward the same margin expansion. And Rick Rule's detail matters. With 82% of global silver coming as a byproduct, supply isn't controlled by silver economics at all. That disconnect creates volatility investors routinely underestimate. If margins hit sustainably 150-200%, the narrative shifts fast. And the next section shows why high grading adds hidden fragility beneath those margins.
That's a fancy way of saying they high graded, and that will impact their results for a couple of years going forward, because it is unlikely that they haven't picked the eyes out of some of the pockets they've mined. So you have to deal with that.
Yeah. Okay, but so relatively though, we are getting very close to a point where the silvers in terms of margins must be catching up with the gold guys. So if most gold companies are making ASIC of around 1,500, 2,000 on the high end, that's anywhere between 100, 150, maybe 200 if you're one of the lower guys. On top of silver guys are pretty much there, right? So is this why we're now starting to see that shift into silver juniors and silver?
Right now, the move in the silver juniors isn't fact-based. It's moved around silver in the anticipation that the stocks will do well. Yeah. For it to become real, the market is going to need to see a bang-up quarter out of Hecla, or a bang-up quarter out of Core, or better yet, both. Yeah. A bang-up quarter out of Pan American, and they're going to see that. It's important to note that most of the real silver companies are gold companies in drag.
This part exposes a structural risk. High grading inflates short-term margins but steals from future production, meaning the next few years could show weaker grades even as sentiment strengthens. Rule points out that silver companies are only now approaching gold-like profitability, but the current surge in junior silver names is based more on anticipation than earnings reality. Investors won't get confirmation until companies like Hecla, Kerr, or Pan American deliver breakout quarters. Until then, the rally is running ahead of fundamentals. And what comes next digs into why earnings validation can flip a speculative run into a true cycle.
More than half of their revenues are gold. but they're still extraordinarily leveraged to silver. It's important to note, too, that while gold is not merely at nominal all-time highs, but probably in constant dollar all-time highs, silver is far from an all-time high. $57 comparing to 50 forgets the fact that 15 years has passed since the last time they were at 50. The dollar's deteriorated.
The first time silver hit $50 was what, back in the 70s, wasn't it? So nominally, based on that,
it's probably 220, 225.
Yeah, true. Because we were talking the other week, right, back in Zurich, and you were saying that you sold 25% of your portfolio, limited or basically got rid of your downside completely. You were investing in Agnico, from memory, Wheaton, Franco, physical gold, and then some oil and gas stocks.
Right.
Are you not tempted? I mean, you're talking about back when you first joined the industry, you saw some silver plays go from cent stocks to $45 stocks. Are you not tempted, or are you already positioned in silver?
I've got a good position. As you know from earlier interviews, I love hate.
Yeah.
In 2021 and 2022, the junior silver stocks were hated.
It's striking how this quietly exposes a valuation distortion investors keep ignoring. Silver's inflation-adjusted high, near $220, shows how disconnected today's spot price is from long-term purchasing power trends. And Rick Rule's reference to Wheaton and Franco underscores that institutional capital already positioned early. Even more telling is his mention that junior silver stocks were hated in 2021 to 2022, usually the phase when smart money accumulates. For investors today, the question isn't whether silver moves, but whether they're already late to the rotation. And what he reveals next clarifies what too late really means in a commodity cycle.
Yeah,
I mean, truly hated. It was very clear to me at that point in time that Vizsla was going to be a mine. And nobody wanted it.
Yeah.
The consequence of that is I didn't just buy it, I bought a lot of it. Yeah. And so, I would suggest that in the silver names that matter to me, I've got plenty.
Is it too late? So sometimes, like, one of the things that a lot of people do is that they'll look at, in a market at the moment, you'll look at like a Fresnillo or a Hecla or whoever, the big producers, even the big developers like a Vizsla, and will be at all-time highs, and their stock price will be at all-time highs as well, and you'll think, blimey, I've missed the boat.
I think arithmetically, no, but that depends on the individual and his or her time frame and their tenacity. I've become very patient and very tenacious, not because I don't wish for instant gratification, but because I've learned over 50 years in the markets that instant gratification is not on offer. Right. An investor who is prepared to stay the trade for 5 years is by no means too late. Yeah. Let's look at the arithmetic. 2 interviews ago, not the one in Zurich, but the one before that, we talked about the fact that I believe that over 10 years, the US dollar loses 75% of its purchasing power.
This part delivers a calm reminder that all-time highs often scare off the very investors who would benefit most from early-stage secular trends. Rick Rule's emphasis on Vizsla being obvious before the crowd mirrors classic value setups, deep pessimism before the mine build-out is priced in. The arithmetic he cites is sobering. If the dollar really deteriorates 75% over a decade, nominal prices across commodities shift dramatically, meaning current highs may be tomorrow's cheap levels. Long-duration conviction, not timing perfection, determines outcomes in these cycles. And the next section pushes that arithmetic into even sharper focus.
Yep. If it does that, I would expect that gold would maintain its purchasing power, which means that over 10 years, I see gold in nominal terms between 3 and 4 times higher than today. In prior bull markets, once the crossover has occurred, once silver begins to outperform gold, the performance in silver is roughly double the price of gold. I'm not saying to you that silver is going to go 8 to 1. What I am saying is that a move higher in silver, from my point of view, is statistically extremely probable. Right. If one looks at history too, the higher quality silver juniors outperform the silver price 2 to 1. So if you follow that arithmetic progression, what I'm saying is that there's a possibility, if not a probability, that over 10 years, a portfolio of high quality silver juniors could give you a 20 to 1 return. Your investors shouldn't think in their mind. Rick Rule just said that Amalgamated Moose Pasture Silver is going to be a 20 bagger. I'm not saying that. I'm saying if you follow the arithmetic progression, that there's a very good probability that a carefully chosen portfolio of high quality silver juniors has the potential for persistent and tenacious speculators to generate a life-changing event.
The real shock here isn't the bullishness, it's the arithmetic behind it. If gold triples or quadruples over a decade, and silver historically outperforms gold by 2.1 in confirmed bull phases, the compounding effect on high-quality juniors becomes mathematically explosive. Rule's mention of 20.1 potential isn't hype. It's tied to documented performance in past cycles, including the 1970s and early 2000s. But the key phrase is carefully chosen, because sector-wide junk dilutes these gains. The next part grounds that arithmetic in historical precedent.
One of the numbers that you gave me last time was about 75% degradation in the purchasing power of the US dollar. I think you came up, what was the gold price figure that you came up to, or did you not give me one?
Well, what I said was that I expect that gold will maintain its purchasing power.
Yeah.
If the US dollar lost 75% of its purchasing power, and the dollar maintained its purchasing power, that would suggest a 3-fold to 4-fold increase. It's simple math.
Okay, so potentially $8,000 to $12,000 gold.
Yeah.
Over a 10-year period.
I would be surprised over a 10-year period if the gold price wasn't measured in 5 as opposed to 4 digits.
Years ago, I used to watch interviews of people say the gold price is going to go to 3,000 or the gold price is going to go to 4,000, 5,000. And I've said this before on the channel, I used to think these people were barking mad. I generally thought they were nuts. And then it's funny how times change, especially when you're in a bull market. You say 8,000 to 12,000. I don't sit here and think that's outrageous. I actually think it's probably more of a likely probability than not.
Markets are shaped by narrative, but investment decisions should be shaped by arithmetic.
What's striking here is how a once crazy price target becomes reasonable the moment you adjust for dollar erosion. A 75% decline in purchasing power is not theoretical. CPI data over multiple decades shows similar long-term decay rates, especially during debt-heavy eras. Rick Rule simply applies that math to gold's role as a purchasing power anchor, yielding the $8,000 to $12,000 range. Investors often dismiss these numbers because they ignore the denominator, the dollar. Arithmetic, not emotion, drives this projection. And the next part shows why history backs that arithmetic more than most realize.
So let's look at 3 different pieces of math. The last period of major dollar instability in my lifetime was the decade of the 70s.
Yeah.
The US dollar again lost 75% of its purchasing power, and gold went up 28-fold. If you had told most people, myself included in 1970, that gold was going to go to $800 from 35, I would have accused you of smoking a then illegal substance.
Right.
You know, the second piece of arithmetic is simply that number, the deterioration of the US dollar. We covered in a prior interview the debt owed by the US government and the ability or the inability to service that debt. The inevitability that they inflate away
well, they have to.
their unfunded liabilities. So, you know, those are 2 important pieces of math. The third piece of math is this. While gold has performed in a way that you and I understand, most of the investment community still can't spell gold, despite the fact that it's a 4-letter word. It is very, 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 very underowned.
This part quietly exposes the most powerful and most ignored precedent in modern financial history. A 28x move in gold during the 1970s wasn't speculation. It was the mechanical result of a collapsing dollar and runaway liabilities, conditions we're seeing echoes of today with US debt above $34 trillion. The fact that most institutions remain underweight gold despite these parallels shows how sentiment lags reality in every cycle. Under ownership isn't a bullish slogan. It's a positioning imbalance.